Once you discover day trading, there's no going back. The genie is out the bottle.
I wanna try turning $100 into $10,000.
Seeing trading gurus flex Lambos and mansions,
super tall ceilings.
you start dreaming of your own riches and freedom. You open a trading account, deposit some money, but then you get hit by reality. You lose and liquidate account after account. You buy courses, watch mentorships, join signal groups, but somehow you still can't crack the code. Supply, demand, bull flag, ICT mentorship, fair value gap, imbalance, swaggy, liquidity. Nothing seems to stop you from losing. How do we stop bleeding money, and how do we finally get to the Lambo? Here are the key risk management rules every trader should understand if they want to become successful. Number 1 is wear a stop loss. You wouldn't drive a car without a safety belt, so we shouldn't trade without a safety belt. Don't trade without a stop. Having no stop puts you at an infinite risk. Any candle at any moment can completely bar up or down for no apparent reason. Can you predict the market? No, otherwise you would have been profitable. So stop indulging in the feeling of, I know it's going to go in my direction. If you were so sure it would go in your direction, then why not place a stop loss? It's not going to stop you out anyway since you're so sure you're right? Right? No, exactly. Set a stop loss. Number 2 is set a clear rule for your stop loss. So many beginner traders don't have a clear rule for their stop loss. This used to be me. They base their stop loss on money, and every trade they put their stop at a different place. Sometimes the swing low, sometimes in the middle of the trend, or worse, at a random candle. The best definition for setting a stop I ever came across is, your stop loss should be at the point where your trade idea is no longer valid. If your strategy is based on a trend continuation, the most logical place for a stop would be where? The place where the trend is broken and it's no longer a trend continuation. Simple logic. Where is my trade idea wrong? That's where you place the stop. The same goes for entries and take profits. Define clear rules so you don't have to trade based on feelings, which will always lead to liquidating your account. Number 3, once you set your stop, stick to it like gum sticks to school desks. The worst mistake beginner traders make, and I was guilty of this, even the pros do this sometimes, is changing their stop loss or deleting it altogether. If I delete my stop, the market maker can't get me. Wrong. If you delete your stop, the market can now take your whole account. Think about it. If the trade is already going towards your stop, what does that mean? You were probably wrong about the trade. Don't close early either. If it's going towards your stop, let it hit. I've had so many times where price came within 2 points or even 1 point of my stop loss, and then it completely reversed and it got to my take profit. Don't close early, don't move it, don't do anything with it. Accept the risk. Once you're in the trade, consider the money already lost. Kind of like when you lent money to a friend. Number 4, risk the same amount of your account on every trade. Amateur traders risk based on their feelings. Risking more after a loss so you can recoup the money is a slippery slope. The goal of trading is not to never lose. The goal of trading is to have a statistical edge that makes you more money than you lose over a long period of time. A good rule of thumb is to risk 1% of your equity. Look at this graph. It shows you how much you need to win according to your drawdown to get back to your starting balance. Notice that the loss percentage versus how much you need to make to get back is unequal. A loss of 50% needs to be met with a profit of 100%. Drill this into your head. The benefit of risking a percentage is that when your equity goes down, your money risk also goes down. 1% of 1,000 is a $10 risk, but 1% of 900 is a $9 risk. The opposite is also true. As you make profit, your dollar risk increases, leading to gradually bigger wins. Every trader needs to find out what certain percentage is right for them. 1% is just a starting point, but if you have a very high win rate, let's say 80% or even 90%, of course, it's easier to risk a little bit more than 1%. If you are trading smart money concepts and you have a 30% win rate, it's not smart to go risk 4% every trade, because the chance of you having a 10 losing streak and being down 40% is pretty high. So you have to find the right balance between the percentage risk and your win rate so that you don't get into hefty drawdown. In summary, risk a fixed amount per trade and then set clear rules for your entries, stops, and take profits and stick to them. If you do this, I can guarantee you will see improvements and you will stop blowing accounts. You would do me a huge favor if you can click the like button, leave a comment, click subscribe, and hit the notification bell. I will guarantee you I will deliver you more valuable content around trading and investing. Stick with the journey through up and down. Much love and peace.